The U.S. inflation rate has recently reached its lowest point in 3 years, offering some relief to consumers who've been grappling with rising prices since the pandemic. While this is a positive development, the situation is more nuanced than it seems. Inflation may have slowed, but there are still price pressures in certain areas of the economy that are impacting people's everyday lives. First, let's take a closer look at what has been driving inflation down. Over the past few years, inflation surged as the economy rebounded from the COVID-19 pandemic. Supply chain disruptions, labor shortages, and increased demand for goods led to a spike in prices across the board. The Federal Reserve responded by aggressively raising interest rates in an effort to cool down the economy and bring inflation back to a more manageable level. These rate hikes are starting to show their impact. The cost of goods like gasoline, used cars, and certain food items has fallen, contributing to the lower inflation rate. The decline in energy prices in particular has been a major factor in easing inflation. Crude oil prices, which surged after Russia's invasion of Ukraine, have stabilized, leading to lower prices at the pump. This is great news for consumers who've been feeling the pinch of high fuel costs. Another reason inflation has slowed is the gradual normalization of global supply chains. During the pandemic, disruptions in manufacturing and shipping caused delays and shortages, driving up prices. But now, with factories back online and shipping bottlenecks easing, the supply of goods has improved, reducing upward pressure on prices. The reduced cost of freight and logistics has also contributed to lower prices in various sectors, particularly in consumer goods. Additionally, consumer spending patterns have shifted. During the pandemic, there was a surge in demand for durable goods like electronics, home appliances, and cars as people adapted to a more home-centric lifestyle. Now that demand has softened, allowing prices to stabilize in those categories. However, despite these improvements, there are still areas of the economy where price pressures remain strong. One of the most significant sectors experiencing persistent inflation is housing. Rents and home prices continue to climb in many parts of the country, driven by a combination of high demand and limited supply. The affordability crisis in the housing market is putting significant financial strain on many Americans, particularly first-time homebuyers and renters. The cost of shelter is one of the largest components of the Consumer Price Index, CPI, and it continues to be a key factor keeping overall inflation higher than desired. While some cities have seen a slight cooling in home price growth, others continue to experience rapid increases due to population growth, low housing inventory, and high construction costs. Despite a decrease in overall U.S. inflation to its lowest level in 3 years, essential costs such as housing, food, and healthcare remain elevated, affecting daily life for many Americans. The agricultural sector faces challenges like extreme weather, rising input costs, and labor shortages, keeping food prices high, particularly for meat, dairy, and fresh produce. Healthcare costs continue to rise due to increased demand and higher wages, adding financial strain to households. While the Federal Reserve has managed to lower inflation rates, interest rates for loans and mortgages remain high, complicating major purchases and debt repayment. Businesses experience relief from lower inflation but face rising labor and material costs. Looking ahead, inflation may continue to decline gradually, but risks remain from potential global disruptions. Americans are advised to manage their finances cautiously, especially in high-cost sectors, as the economic landscape evolves. Please like, share, and subscribe.